What's going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. I'm your host, Alex Ivanovich, and obviously, this week in the market, there was no shortage of headlines. I feel like I've said that a few times now on this show, the last few episodes. Last week, we had a special episode. We had Ethan Whites on, and we discussed a lot of things. So if you missed that, go check that out. Today, we're going to go back to the same format that we've done in the past. I'm going to go through 5 questions that I received this week from listeners, viewers, friends, and I'm going to address them in this episode. So, without further ado, I'm going to jump right in. I've got my notes and I'm ready to give you a great episode. So, question number one says, what do you make of Iran/USA? What is your prediction for oil markets? So obviously, there's been no shortage of news on this front regarding the war in Iran between Israel and the U.S. and Iran. So I'm not going to comment too much on the actual politics of the war. I'm not from the U.S. I'm not from Israel. I'm not from Iran. I don't feel like it's my place to really talk on this show where we talk about finance and stuff that's going on in the market to really comment on the politics of the war. However, I can talk about some of the things that are occurring in parallel to the war as a result of the battle that's currently happening. So, to answer the question about oil and where do I think oil is going to go? So, obviously, if people watch the markets this week, I feel like I think it was Monday or something like that. Oil touched 120 bucks a barrel. I think I saw the US oil ETF at 120 roughly, or just shy of that. And it has traded in now to about 107, 108. I think I saw the close today. Maybe it was even 106. I don't think, given the Trump administration's agenda on affordability, um, and putting the American citizen first, that they can really let oil get to 120 again or stay sustained above 100. Now, what does that mean for the war? I think there is a motivation within the Trump administration to either have an off ramp, sort of cool this whole thing down, or exit quickly, or just finish it up, whatever that means. As I've said in the past, oil is a proxy for geopolitical risk. And I think while there's a war happening in the Middle East, you're going to continue to see oil well bid above 100. Now, what are my views for the future on oil? Like I just said, I think there probably is a motivation within the White House. I know there's a lot of posturing and, everyone wants to be a tough guy and say, I'm not going to be the one that folds. But if you watch the stock market right now, there is this inverse relationship between oil and the market. So as oil rips to 120 like it did earlier in the week, the market had a tough time finding a bid and actually sold off a little bit. And it feels like every time that there's been a headline that caused oil to rip, the market has fallen out of bed a little bit. And every time that there was a headline that caused oil to come in, the market found its bid and sort of had a bounce. And I think the Trump administration, they're not, dumb individuals, not all of them at least. I think they're watching the tape. They see what we see when we watch the market. They see the sentiment amongst the public and amongst Wall Street. And like I said, I think there's a motivation to sort of find an end to this. And I don't think it'll be drawn out for months and years like the Russia Ukraine war has been. So that's my opinion on oil. I don't think oil is going to stay elevated above 100. I think when oil prices do settle back to a normal level, obviously, as a function of what has occurred now in the Middle East, there's going to be this risk premium priced into oil a little bit. So I don't think you're going to see oil back at 55 to 60 bucks a barrel like it once was. However, I think you might see oil at 80, 90. I just don't think it's going to stay above 100 because I don't see the war getting out of hand per se. Again, that's just my opinion, and that's based on what I've read and sort of the sentiment that I feel in the market and from the administration. But that could change very, very easily if there were to be some sort of surprise event. Maybe some other country that has not been historically aligned with the US joins the war on Iran's side. I'm not saying that this is going to happen. I don't even think it's likely that that would happen. I'm just saying an event like that would obviously see oil rip again. So let's move on to question number two. It seems the bid in software has reversed a bit even after a strong Oracle print today. Are you staying long Microsoft and software in general? So initially, you guys know I was long Microsoft because I wanted to be long software. I wanted to have some exposure there on the long side. I've since actually clipped my Microsoft position, but not because I fell out of love with software. I clipped my Microsoft position because I am growing weary on the hyperscalers in general retaining a bid. So I know Amazon is not your typical software play, nor is Google, nor is Meta really. They wouldn't really be priced as a software company, but there's other names within the software group that I think have better mid to long term potential on the long side that isn't Microsoft, who is burning through a lot of money. Their free cash flow quarter over quarter is shrinking and their capex is growing. And I don't think the market is rewarding these companies, these hyperscalers, for growing their capex in the aggressive fashion that they have been. So I didn't really want to be long Microsoft for that reason. And I looked at other names within the group to be long and sort of have this software trade on. Now, I do realize that software has sort of fallen out of bed the last few days. I think these are short-term worries. Obviously, there is some private credit concerns. A lot of this private credit is exposed to software. I personally think there's still some high-quality names in that group that could find their bid. They're still historically cheap, in my opinion, and they're not a bad place to hide. That's just how I feel. But I am reducing some exposure. And on that rally that we did have in software, I did take some money off the table. And like I said, I did remove the Microsoft position completely and rolled that money into another name that I thought was attractive. So that's what I think about software. That's what I think about Microsoft. I don't have a whole lot more to say on that. So let's move on to question number 3. Were there any mistakes or victories you made trading this week? Anything for a beginner like myself that could be beneficial? Yeah, there was definitely some victories. There was also some mistakes. I think I've talked about mistakes in the past. I'm going to focus on another mistake that I made this week when I'm answering this question right now, but it's a mistake that I haven't really touched on in the past, I don't think, in an episode. So similar to having a risk amount, how much you're going to risk on any given trade or investment, you also need to have an amount that you stand to gain. Because if you don't have an exit plan when you're in a winner, you very well might just sit through it and the stock might come in all the way back to your cost and you sat there and didn't do anything because you thought the stock would continue for forever. I didn't do that per se, but I did the opposite where I choked off a stock a little bit too early. It was a very, very high beta name, meaning it was going to move a lot more than a typical stock. It just had news the day prior, and I didn't price in the fact that this stock could potentially move 10 or 15% in a matter of hours. So to answer the question, did I have any mistakes this week? I think understand the names that you're trading. Some stocks, for example, there's some stocks in biotech that are not going to trade. There might be the same price as some names in utilities, but they're not going to trade apples to apples. Utilities are low beta names. They're not going to move a whole lot no matter what price they are really. And you have some stocks in biotech that are $1 or $5, and they might move $1 in one day. That's obviously a ginormous move in a stock that's that cheap. So understand the stocks that you're trading and have a level where you take risk off the table, i.e. if you were risking, let's say $500, you have to understand okay, for the trade to be worthwhile, how much do you need to make? What's your expected value? So are you going to stand to make $1,500? Are you going to stand to make $2,000? So there was a trade this week where I didn't really price in the fact that the beta was a lot higher than the market average. I cut it off way too early. The stock continued to rally so much more. And I felt like I made a mistake there and I should have known better. So that was a mistake. It was a good learning moment for me. And I'm passing that knowledge along to you because it's really important to understand the names that you are trading and what propensity do they have to move. I think that's a big part of it. You're never going to sell the high and you're never going to buy the low, but you need to have a rough idea of how much something can move and take money off the table when it's reasonable. And remember, always keep a piece. If you're long 1,000 shares or something, for example, and it gets to your price target where you thought this is an acceptable place for me to remove risk and book some money, maybe sell 3/4, sell 750 shares of that 1,000 that you bought, and keep 250 shares. If that stock ends up going up another 3 points, you're not going to kick yourself and feel so bad about it. You're going to capitalize on that little bit of an extra move that maybe you didn't price in. And I think that's a good strategy, and I do that often as well. Let's move on to question number 4. You talk the bear case a lot regarding the market. What, in your opinion, are the catalysts that drive the S&P to break out above 7,000? Okay, so this is basically, the opposite of talking your book because if you know me, I'm pretty bearish on this market. I'm just going to say this. The market right now is trading roughly the same place it was 4 or 5 months ago. We've been sort of in this flat tape that just bounced between these two levels. It hits 7,000, it comes back in. It hits 7,000, it comes back in. And it sort of found this base. And when you take into consideration the risk profile in the market, there is a war going on in the Middle East. There is oil sustained above $100 right now. There is reduced certainty in free cash flow being able to grow in the hyperscalers. I don't think there's any certainty whatsoever. The cash flow numbers are burning quarter over quarter in all of the hyperscalers, and those names are beginning to get punished on their earnings when they report stuff like that. So if there's any sort of cutback in capex, to sort of preserve free cash flow, that's going to be a huge headwind to the market. I feel like there's so many risks in this tape right now at an S&P that's trading at 25 times earnings that I think the risk to reward profile is pretty scary here. And I wouldn't want to be long the S&P 500 for a breakout move above 7,000. Am I saying that's impossible? No, anything in the market is always possible. This is a game of probabilities and you're never going to know anything for certain. You're just always going to have your best hunch, and we always play the probabilities. So in my opinion, I think the probability of the market breaking out above 7,000, given the amount of risk that this tape has. So just think, 4 months ago, when there were not any of these risks that I just mentioned, this S&P 500 couldn't break out above 7,000. Now you have so many other things in the tape going on that the market is not really pricing in whatsoever. I feel like the propensity for the market to break out above 7,000 is so much lower than it was 3 or 4 months ago. And that's scary to me. And it's not a tape that I want to be long. I want to be net short. But to answer the question, because someone asked, what is the catalyst that drives the market higher? I don't think that the war in the Middle East ending is a catalyst for the market to break out above 7,000. Again, prior to the war even beginning, before there was any bombs dropped in Iran, the market did not break out above 7,000. So for it to break out as a result of the war ending, I don't think that makes any sense. Like I said about the risk premium in oil, you're going to continue to have an elevated price in oil, even if the war ends swiftly and oil goes back to 80. You will see a rally in the tape, but I don't think it would make sense for the tape to rally above that 7,000 level and have this breakout moment where we continue to 7,500 all year. I don't think that makes sense. It's not what occurred prior to the war. I don't think it's what's going to occur after the war ends. And take into consideration, if the risk premium on oil keeps oil at 80 or 90, that oil is an input cost to nearly everything in our economy. So you might start to see that show up in the inflation figures that will force the Fed to not cut rates. They will have to keep rates elevated at the level that they are. And all these folks, all these analysts that have been pricing in rate cuts all year, I think you're going to start to see those estimates go away. So to answer the question, I don't know that there is a lot that could cause the market to rally and break out. But maybe something that happens in AI, obviously, if AGI becomes a thing, which I don't think it will, given everything that I've read. I don't think AGI is going to come in the next 2 months to cause the market to rally above 7,000. One hot take, though, I think if the hyperscalers start to dial back their CapEx, that would obviously be very negative for all the names in energy, in data center infrastructure. That would be very negative for all those stocks, NVIDIA included, AMD included. Obviously, the semiconductors are a huge part of the index, and it would be a drag on those names. But you have to remember, Microsoft, Apple, Tesla, Google, Amazon, they are huge constituents of the S&P 500. If one of them says we're cutting CapEx back because we value free cash flow more than spending on something that we don't know has a positive ROI, and you start to see some of the other hyperscalers follow suit, you might start to see a rally in some of these massive names in the index, and that might cause a rally in the tape. Potentially. I'm not sure, and I don't know that that's going to occur. So the final question here is, why is the tape so resilient in the face of so many things going on in the world that feels very negative? So I feel like I sort of talked on this earlier a little bit in one of my other answers, but one thing that I maybe didn't mention, and it was something that my mentor mentioned to me that I didn't really clue into. I think the narrative, and not just the market, but in the algorithms that trade the market, is that geopolitical risk stuff like wars happen quickly, especially when the USA is involved. They happen quickly and then they go away. So that might retain, you might retain a risk premium, geopolitical risk premium in oil. But I think the market is buying any dip because they think any day now the war is going to end. I think that's why the tape is so resilient. I don't think that there's any active money manager that is buying this tape here. They might be buying specific names that are cheap. They might be going long software. They might be, finding some defensive names that they find attractive. If the world starts to look a little bit bleak and you start to see GDP growth numbers contract, et cetera, et cetera, there's people that are maybe hiding in some safer names. But I don't know that there's anyone getting too aggressive on the long side with everything that's going on in the tape right now. It just wouldn't make sense to me. Again, I'm 25 years old. I'm not the be all, end all, know it all of everything. There are a lot of people out there that participate in the market that are a lot more sophisticated than myself. I'm just not sure that there are people, actual people that manage money that are excited about this tape at this level, struggling to break out the last few months with everything going on in the world. I think this is very algorithmically driven. And that's why the dips are being bought. And that's why the tape is so resilient, in my opinion. And so it's not a great answer, but it's something that I'm picking up on and it's something that I'm watching. I'm really interested to see how this tape unfolds over the next month. I feel like we're going to get some sort of news on the Middle East front with the war happening there. So we'll see how the tape reacts. I'm interested to see where oil settles. There's a lot going on, and there was a lot of earnings this week. And we're going to continue to get some more earnings. But that's all I have to say for this episode. I hope you enjoyed it. I tried to give a little bit of insight. I'm not really great with the macroeconomics talk all the time, but I do try my best. I read a lot and I try and convey some of that to you guys in these episodes. So thank you so much for listening to That Makes Zero Sense. There was a couple things in there that really don't make sense. So we'll see you next week on next week's episode. This will drop on Friday, 2 days from now. Be sure to follow us on TikTok, Instagram. We post a lot of shorts there. I give little market updates. I post little snippets of these podcast episodes if you don't want to digest the whole long form. So anyway, that's all I have to say today. Like I said, thank you so much for listening. Take care. I hope you have a fantastic weekend and a happy Friday. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.